Today's presenter, Justin Miller, is CEO of Universal Bookkeeper. Universal Bookkeeper is located in Utica and offers services ranging from accounting and bookkeeping to consulting to tax preparation and payroll. Also on hand for today's presentation is Mohawk Valley SBDC Business Advisor Shelby Sweet. Along with Justin, Shelby will be on hand to answer your questions during the Q&A session that will follow today's presentation. Your host for today's webinar is the Mohawk Valley Small Business Development Center. The Mohawk Valley SBDC is part of the New York Small Business Development Centers network of 22 campus-based centers and outreach offices across New York State. Our centers provide free business advising and research, as well as free or low-cost training to startups, entrepreneurs, and small business owners. I am your moderator, Zach Steffen, Business Advisor at the Mohawk Valley SBDC. A couple of housekeeping items before we get started. If you have any questions, please type them in the question box using the button at the bottom of your screen. We'll have a Q&A session following the presentation. All attendees will receive a follow-up email later this week containing a recording of today's presentation. And with that, I'll turn things over to Justin.
All right, great. Hey, thank you, Zach, for that introduction. Welcome everybody to this webinar on bookkeeping. You know, if you are just getting into bookkeeping for the first time, 2021 is the perfect time to start. But, you know, I think this is also going to be important and helpful for people who are coming out of 2020 and trying to figure out how they could fix a lot of problems that they may have created for themselves and their business. So we're going to talk about 3 different sections. Number 1, the importance of bookkeeping. Number 2, the workflows and procedures that I personally would recommend as you develop your processes. And then number 3 is some of these self-employment, business, and tax considerations that I would recommend you keep in the back of your mind for your business. But really quick first, I just want to give you 20 seconds about myself. I am a CPA. I started Universal Bookkeeper in 2015 with my wife, and really we focus on helping small businesses with their accounting, bookkeeping, and tax needs. You know, I always tell clients, you guys know your product very well, but the amount of time that you spend on the back end keeping your financial house in order takes away from you doing the best for your clients. So if you can hand that off in a cost-effective way, that's where we can help clients very effectively. We do virtual accounting work for over 40 different businesses, both here in Utica and then also scattered throughout New York State and the Northeast. If you go to our website, you probably can see some of the businesses that we work with, and I bet you that you would recognize a few of them. You know, we also do over 350 business and personal tax returns annually. And lastly, I just want to point out we are extremely big fans of the SBDC and the Thinkubator. Our company was one of the originally Thinkubated companies back in 2015, and for the first year of our business, we actually worked out of the Thinkubator site. So highly recommend that. And currently, we also rely on the SBDC to help us with not only business research services, but also just general counseling and coaching. So if you haven't utilized their services, you know, definitely reach out to them and check in with them. So with that, I will kind of move on into our first section. So the importance of bookkeeping. Let's see. All right. So why is bookkeeping so important? And so the number 1 thing that I always fall back on is you need to have your financial records in order for tax preparation. So at the end of the year, I mean, we're getting into this right now. Most business owners, they struggle with preparing a financial statement that is meaningful enough to help them prepare their taxes at the end of the year. So most clients wait and try to just, you know, mass do this in one lump sum in January, and it's really not a good thing because you could be missing a lot of transactions, a lot of things that are applicable for your business along the way. General organization. You know, bookkeeping is not just about adding up the numbers to get totals. You know, it's about developing a workflow for your business to help you manage money. Chances are, if you don't have a good workflow to keep your financial records in order, then there probably are other areas of your business that are lacking in a workflow as well. And so one of the best pieces of advice I can give to you as a business owner is to develop your procedures and workflows for every aspect of your business, not just bookkeeping, but to put them on paper and to stick to them. Because if you don't have a consistent process or procedure, then you probably don't have a consistent product that you're giving out. The third reason, analysis of performance. This is something that I'm going to talk a little bit about later, but how you should be analyzing your numbers on a regular basis. I recommend monthly to see how your business is performing, and you're going to be utilizing that financial information to help make small tweaks to your business so it'll make you more profitable in the future. Budgeting. I love budgeting. I do it several times a year, and I get actually really excited when it comes to budgets because I love to create a plan for the future. I will always tell clients, don't just throw numbers at a wall based on what you did last year. Start with what the end goal is that you want to achieve. A lot of you are maybe doing this on a part-time basis. Start with what you want to take away from this business. How much do you want to make? How many days a week do you want to work in it? And then you can use a budget to back into how you're going to achieve those goals. And it may not be achievable in 1 year, but you can possibly plan out that budget over multiple years to get that goal. Reporting to outside organizations. So this would be, to your banks as you're applying for loans. Every banker is going to ask for some kind of a financial statement so that they can gauge the performance of your business. Nobody's going to give you money just by you telling them, yeah, we make money, we're profitable. They're going to want to see it on paper. And so if you don't have this information readily available, number one, it's a struggle to come up with on the fly when your bankers need it and you need that money from them immediately. But the bank's not going to really take you that seriously if you're just going to give them a piece of paper with some chicken scratch on it that's got some numbers on it. I work with a lot of bankers directly, and I can say that that is the number one issue that they see with business owners that are trying to obtain financing is the lack of readily available financial information. And the last reason why it's important is because of audit purposes. Now, I hope nobody ever gets audited, but just know that it's a regular thing. And just because you're selected for an audit does not mean that you have done something wrong. It just means that you were randomly selected. But having all of your financial information in order so that you can give it to the auditors very easily will prevent a lot of problems for you in the future. Okay. So next I want to talk about, what is the difference between accountants and bookkeepers? And if you're going to be utilizing somebody in the future, here are some of the things that you can keep in mind when you're speaking to these individuals. So a bookkeeper is really all about transactional based items. So they are going to be entering expenses, entering revenues into a system. They're going to be making sure account balances are accurate. They might be posting interest to loans and things like that. But the accountant is really taking that financial information to the next level, and they're going to be preparing reports that are helpful for you to analyze the business. So some of the questions that an accountant may ask as he's looking at financial reports are things like, not only is your business profitable, but how profitable as a percentage of sales are you in this month, in last quarter, compared to prior year? What has changed incrementally by looking at a month over month or a period over period report that would tell me what has changed to deviate that number. Some of the areas that would be beneficial for you to trim your spending on, looking at a month over month financial picture might highlight, hey, I'm consistently spending a little bit more in advertising, and I got to dial that back if I'm going to maintain my goal profitability number for each month. And it's also an accountant that's going to be utilizing that information and building that into a forecast for you. So there's a couple of forecasts that you can think about. There's a cash flow forecast, so you can think about how much cash you'll have in your bank at the end of a particular period. But you may be doing a tax forecast to see how much you're going to owe to the IRS at the end of the year. So an accountant is going to take all of that information and really build something out of it for you, as opposed to a bookkeeper that's really not diving into that high level information, but really entering transactions on a daily basis or regular basis. Okay. The next thing I want to chat about is just to give everybody a really quick overview of the standard financial reports. So we've got an income statement and a balance sheet. Those are the two that most bankers are going to want to see, and the most readily available reports that accountants use. So in this slide here, you can see there's an example of a very simple balance sheet. I realize it's probably a little bit small, but bear with me here. So a balance sheet is a snapshot of the current financial status of your business. So in other words, it's a report that will help you analyze the financial well-being of your business. So as you can see at the top, you've got your assets, you've got your current cash, your checking and savings account. This report is going to be based on any particular day. So it's a snapshot in time. Okay. So as you can see, the report is dated as of December 30th. Okay. Those are the cash balances as of that date. It's going to show you things like accounts receivable, how much money your customers owe you as of this date. A little bit lower under the liabilities, you can see accounts payable, how much money you owe to your current creditors. Long-term liabilities. So these are debts that are going to be payable to somebody else over a period that's greater than 1 year. Okay, different from current liabilities or accounts payable items that are due in less than 1 year. So that's a quick deviation. And then at the bottom, it's going to show you the net income of the business, which plays into the equity side of the balance sheet, but is basically that summarized number of what your income statement is going to show. Now, why do they call it a balance sheet? It's because your assets, that assets equal your liabilities plus your equity. So you can see 23,000 plus 31,000 minus 7,000. That's why they call it a balance sheet. So your income statement. So this is the one that everybody focuses on, and I will actually say that as an accountant, a CFO, a CPA, I tend to spend the majority of my time focusing on the balance sheet because that gives me a little bit more information on how the business is doing. I think that most business owners focus more of their efforts on the profit and loss, and that gives you, the bread and butter of how your business is performing. So an income statement shows the performance of your business over a period of time. As you can see, the revenue is on the top, and then below that you have what's called the cost of goods sold. So these are all costs that are associated with making a product. So think about, if you are selling cupcakes, your cost of goods sold would represent all of the ingredients that go into making those cupcakes. So the flour, the sugar, and also things like the paper boxes that you would sell them in. Those would be cost of goods sold items. That's the cost of creating a product. Below that, you have all of your expense items. So these are all the different categories where you're tracking to see how you're spending your money. You've got advertising, equipment rentals, insurance. Below that, you have your net income, your profit. So that's going to be your revenue minus your cost of goods sold minus all of your expenses. That's going to show you if you're tracking your income on a cash basis, what money should have come from the sales that you have made during the period. Okay, positive is good, negative is always bad, but small business owners really tend to rely on this report to tell them, how much money they made, if they can pay themselves in the future, take a cut out of the profit. Okay, so moving on. So the next section that I want to get into is bookkeeping workflows. So in this section, I'm going to talk about different techniques that I have recommended to clients and or used myself to help small businesses keep track of their financial records. Okay, the first and a very, very simple way to do this is to start by making sure that your business and your personal bank accounts are separated. Same thing with credit cards. And make sure that you're only using a set number of accounts or credit cards for business purposes, and you're not using your personal bank accounts for your business. And I'll explain why that's important in a second. But if you are exclusively using a separate bank account, let's say a checking account, to track all of the expenses and revenues for your business, one of the easiest ways to track the profitability is through that bank account. Now, obviously, you could look at the current bank balance to see if you have been profitable over a particular period. So if you're showing a positive bank balance, obviously you're making money. If you're negative, if your bank balance is negative, obviously you're losing money. But I will tell clients that if they're looking for like a really dumbed down, easy way to keep track of their expenses, start with separating your business and personal bank accounts. And then periodically what you can do is you can export all of those transactions from your bank account into Excel. And then you can start to categorize them into the different buckets that would be applicable for reporting or tax preparation. So, very easily you could say every deposit is just revenue, and just, call every deposit revenue. And then what you can do is you can highlight each different transaction and help you code it to different buckets. So at the end of the day, you can see how much money you spent on advertising, how much money you spent on software and applications. That would be a very simple way to keep track of your expenses. No additional accounting software needed there. The other reason why this is extremely important is for a term related to a term called piercing the corporate veil. So this is most applicable for entity types, so LLCs, corporations. And what you want to keep in mind is if you are out there and you have a LLC that you're using for your business, if you are not utilizing a separate bank account to keep track of all of your business related income and expenses, and you're using your personal account, you are actually opening yourself up to liability. So let me give you an example. If for some reason in the course of your business, one of your clients is not happy with you and they sue you for maybe breach of contract, if you are utilizing only those business accounts, that liability is only subject to the assets that are available in those business accounts. However, if you are using your personal bank accounts to run your business, the IRS or the legal entities are not going to be able to differentiate by looking into your personal account. They're not going to be able to tell what is a business related expense and what is a personal related expense. And by doing that, that opens up your personal assets to liability just by virtue of you commingling those funds. So whenever you're starting an entity, or if you have a business, make sure you're exclusively using that business bank account. And I also recommend having a separate business credit card for your business. And if you don't have a business credit card or can't get a business credit card, try to find a personal credit card that you're using exclusively for business purposes, so you're not commingling those items. Okay. Okay. Some other low-cost ways to help keep track or keep your books in order. We talked about separate bank accounts. I am a huge fan of QuickBooks products, so my company exclusively uses QuickBooks Online to service all of our clients. QuickBooks Online has a $5 self-employed version that is really enough for most small business owners. So if you're doing a side hustle and you're looking for a very cheap software, QuickBooks Self-Employed costs between $5 and $10 a month, and that's a pretty easy option out there. There are some other products, and I couldn't quote you the cost associated with them, but anything online makes it pretty easy to use. And the reason why it makes it pretty easy to use is you can connect your bank and credit card accounts to that online application, so that every time a transaction goes through your bank or your credit card, it's automatically synced down into that accounting software, whereby you can very easily code it to the correct account or create things like rules that will automatically code it for you. So I've got clients that we've got rules set up for them so that every time we see like a Lowe's purchase, we always code that to repairs and maintenance. So we've created a rule in our accounting software that will recognize Lowe's as a transaction and then automatically post it to that repairs and maintenance account. So using an online software or any accounting software for that matter could create some efficiencies for you. That's why I really highly recommend it. Okay. One last way that I will recommend to help keep your transactions in order is to utilize a spreadsheet that I've actually developed, and it's posted online. So if you see the slide and you follow this link, universalbookkeeper.com/index.php/income statement, it is a spreadsheet that will create an income statement for you. So I'm going to walk through what that spreadsheet looks like for you next. So without showing it live, I'm showing you the 3 different worksheets that are inside the Excel file. So the first worksheet will be a chart of accounts. So this is every account that is currently available to you to code a transaction to. So you can see at the top there's your sales revenue, service revenue, and then below that you've got your cost of goods sold, which we talked about in the previous slide, and then you have your different expense accounts that are available to use. So the Excel spreadsheet is actually made up in a way that if you needed to add certain accounts, you can add a new account to it, and it'll work automatically. On the next worksheet is where you would actually enter your transaction. So on a regular basis, you would be entering a transaction, and you could see the first one. On 12/31, I made a deposit from a client and $100,000, and the category will give you a drop down for the categories that are on the previous worksheet. So you can very easily code transactions, and you don't have to worry about thinking about what accounts do I need to create to make this work for me. They've already been created. So all you need to do is list your transactions in order as you realize them. And then on the third and final worksheet, you will see that the spreadsheet will create this income statement for you. And you can manipulate it by date because it'll recognize the date that you entered each transaction, but it will prepare this income statement that that can be used to give to a bank, that can be used to give to an outside entity for reporting purposes. So this is a free option that's available to you that if you just go to the website, you can download it there. I did want to just really quickly point out, going backwards, that in your chart of accounts that's available to you, you can also see the description of what this account should be used for. So it'll help you to identify, because that's one of the problems that I get, or one of the questions that I get on a regular basis from a lot of my clients is they'll say, Justin, how should I code this particular transaction? And as long as you're doing it consistently, that's the best course of action. But this little tool will help you decide what bucket it should fall in. and you don't have to make up a new account as you go. That's the other problem that I see small business owners consistently doing incorrectly, is creating new accounts to post different transactions in. My rule of thumb is the smaller number of accounts to use, the better. If you have an account that you post one transaction in, chances are you can probably find a different account that it would make sense to merge that transaction into. So you wouldn't need to have 500 different accounts for every different type of transaction. You know, additionally, to the client yesterday, this is the way they actually want to see their financials. But they had a wages account, so a payroll account, but then they had a separate individual sub account for every person that works for the organization. My recommendation was that's a little overkill. You don't really need to break out your chart of accounts by each individual person, but for their budgeting purposes, they were adamant that that was the best way and easiest way to do it. But for most small business owners, you know, keep it simple, utilize this listing of different accounts, and your accountant will be extremely happy that you're not creating things out of thin air. The other thing I want to also point out is this is as much information as you really need to keep for a particular transaction. So the date, the vendor, the description, the amount, and maybe any other notes that you can think. But this is all the information that can be used to, you know, really analyze a lot of information. So once you've got it into a income statement, not only can you slice and dice your information, dissect it by category. So what are my expenses by each individual account? You should be able to sort this by vendor to see what are the regular vendors that I use during a period of time. How has my spending increased or decreased with any particular vendor? And then obviously the date will give you the time frame that is applicable to it. So keep it simple. Only utilize these 4 or 5 different pieces of information when you're tracking your expenses. One other thing that I'll add that is not in this presentation, but clients ask me all the time, how long should I keep my support for audit purposes? If the IRS comes knocking at your door, typically they have 3 years. They can go back 3 years and audit you. But if there's any kind of fraud or deliberate avoidance of taxes, then they can go back up to 6 years and also beyond. So I would recommend, what I do personally is I keep things for 6 years, and once it rolls into the 7th year, I then start getting rid of my backup support. Unless you keep everything electronically, then you can absolutely keep it forever. Okay. So we talked about some of the systems that you can use to keep track of all of your bookkeeping items. So the next I'm going to talk about, I'm recommending, this is the frequency that I would recommend that you perform your bookkeeping tasks at. So on a weekly basis, I would recommend that you sit down and you enter all of the sales and expense transactions for the particular week. Make it part of your routine. Sit down on, you know, Friday morning, and this is what you do. This is part of the workflow, entering those transactions on a weekly basis so you don't get behind. And then on a monthly basis, the first thing that I'm going to recommend is that you do what's called reconciling your bank accounts. And this can be applicable for bank accounts. This also can be applicable for credit card accounts. But what is reconciling? Reconciling is just making sure that you have the exact same information in 2 different areas. So if you are keeping all of your expense transactions, you know, in that piece of software or in that spreadsheet, you're going to pull up the period of time, so a monthly report, and then you're also going to pull up your bank account And what I would do is I would print off that bank statement for the period. And then you're going to have two pieces of information side by side, and you're just going to tick and tie and make sure that every transaction that is recorded in your accounting software is also recorded on your bank statement. And you're going to make sure that every transaction on your bank statement is also recorded in your accounting software. Now, there may be times when things don't line up exactly perfect, and that's okay as long as you understand why that is. So, for instance, if you made a deposit and you recorded that you made a sale on December 31st, but the check didn't actually clear in the bank until January 3rd or 4th, obviously those things are not going to line up, but you know that that is something that's going to clear or reconcile in the following month. So that's okay. But one of the biggest traps that business owners get into is they are recording transactions as they see them into their accounting software, but they never tick and tie the information to their bank account. And why this is important is because you tend to miss a lot of transactions that way. So what you could be doing is you can be missing deductions that are not recorded, expenses that have hit your bank account, but you haven't recorded in your accounting software. And you're using that accounting software to give your income statement to like your tax accountant to prepare your taxes. Well, he's not looking at your support. He's only looking at the income statement that you've given to them. So you've got to take a little bit of onus and make sure that everything is accurate. So obviously that's one of the things that we do for every single one of our clients is every single month we reconcile every bank account, every credit card, every loan, any liability that is available to a client. So that's one of my spiels on reconciling, so keep doing that. The next thing that you're going to want to do on a monthly basis, actually let me just highlight how long this should take. So if you're sitting down and entering your transactions on a weekly basis, doing this reconciliation process shouldn't take more than 5 to 10 minutes. You should be able to go through it very accurately. QuickBooks Online will actually do the reconciliation for you to some extent, as long as you have those accounts connected. So it makes it a little bit easier. Next, on a monthly basis, I like to review my income statement. I like to review my income statement to make sure that everything looks appropriate. I also like to review my balance sheet to make sure that my ending balances for the period look appropriate. But particularly on the income statement is where you're going to be able to analyze the profit and loss of your business. How am I trending on my expenses? Are they going up? Are they going down? Did I hit my revenue goals that I set for myself in my budget for the month? One of the things that I also recommend doing is doing a month-over-month income statement analysis. So when I'm working with a client and I'm reviewing their financials, every single month, I'm first looking at the month individually for appropriateness and looking at the transactions and the underlying accounts. But then I'm expanding it to look at my income statement on a monthly basis because trending is so important. Trending can tell you if something looks out of whack. If you're spending $5,000 on wages each month and then for some reason your account is showing $10,000, that's a big red flag. So I would utilize that month over month income statement analysis to help me find potential problems. Okay. If you're using that spreadsheet that you've downloaded from my website, what you can do is you can actually just save individual copies of the income statement for the month. And then you can put them on one spreadsheet, look at them side by side. That's one way to do it. Obviously, the accounting softwares that are out there will have the capability for you to look at a month-over-month income statement. Okay. On a quarterly basis, this is where you as a self-employed business owner need to be thinking about taxes. So if you're self-employed, you should be paying estimated income tax payments. And so the rule is that you actually need to make quarterly payments that would total either 100% of what your prior year tax liability was, or 90% of what the current year liability is. So if your total tax was $1,000 last year, but now you became self-employed, started a business, and now your business is going gangbusters, and you're forecasting that you're going to be making 3 times as much, well, you need to plan your estimated tax payments out accordingly and be paying them in. So this is where sitting down with an accountant might be helpful. The QuickBooks Online self-employed version will actually calculate your income tax liability for you. So that's one additional tool. But you need to be making a quarterly estimated tax payment. Now, obviously, those of you who get a W-2, your employer is withholding that tax for you automatically. Well, when you're self-employed, that is not happening. So you are responsible for the total tax that is going to be paid at the end of the year. Now, one of the things to also keep in mind is that tax is going to be a percentage of your net income. So if you're not making any money and your net income is 0 or something below, obviously you're not going to be making any estimated tax payments. A lot of the small business owners get confused and they think that they need to make estimated tax payments based on the amount of revenue that they've received. That is incorrect. So it's going to be based on the net income. And then annually, I recommend sitting down with an accountant. I recommend doing it after the 3rd quarter. So that would be sometime between October and November, I would say, to give them your year-to-date financial information, your year-to-date profit and loss, and allow them the opportunity to look through the transactions, look through your income statement, talk about different things that have happened in your business that would be important for you to keep in mind. So maybe you bought a big piece of equipment and you've paid for it with a loan, but you are not coding the interest associated with that loan correctly. So having that conversation with your accountant can help to identify the things that you might be missing out on, additional deductions that you should be thinking about. The reason I say to do it at the end of the 3rd quarter is by then you've got a really good feeling of what your business is going to look like for the rest of the year. If you've got 9 months worth of financial information, chances are you can make an estimate on what the last quarter is going to look like. So meeting with the accountant, super important to help identify different expenses that you might be missing. They might also recommend different strategies that would be helpful for you to minimize your tax burden. You know, maybe you're making a lot of money this year and he says to you, well, you know, are you able to make contributions to like a SEP IRA to invest some of that money if you don't need it? And by doing that, you can lower your tax burden significantly. So I always recommend sitting down with an accountant once a year. If it costs you, you know, a little bit of money, it's probably going to pay for itself hand over foot just by making sure that you've got everything in order. Okay. All right. Moving on. Okay, so lastly in this section, I wanted to just highlight some of the apps and software that's out there for you to use that can help in keeping your books up to date. And maybe some of these are ones that you have heard of, maybe some of these are ones that you've never heard of. PayPal is a really easy go-to one. A lot of clients use this for sending invoices to their customers and receiving payments. Very user-friendly. There's only the transactional fee that's associated with somebody paying with a credit card or an ACH, but it'll allow you to track all of your revenues by customer. Very easy to use. Gusto Payroll. This is one of the, what I would think are newer to a lot of clients, newer payroll softwares that is out there. This is a software that we've transitioned every single one of our clients to, and it's a very low cost program that will automate your payroll software. I will tell a client, listen, if you can log into a online application, enter in the number of hours that each person worked, and then press pay, you can run payroll. This software will automatically pay your taxes that are withheld from your employee's paycheck automatically. It will automatically file your quarterly payroll tax returns. It will file your W-2s and 1099s for your contractors at the end of the year, and it does it all electronically. So every employee that is on your payroll will receive an electronic pay stub each pay period, an electronic W-2, and the employees also have the ability to log in and access their own account, pull pay stubs, make adjustments to their tax withholdings, change their direct deposit, and you don't have to handle that. You don't have to be an HR manager to run payroll. So if that's something that you're interested, I would definitely recommend looking it up. I don't particularly use QuickBooks Online Payroll just because of some of the additional features that Gusto has come out with that have streamlined the payroll process. A lot of people are landlords. So eRent payments, this is a software that I've used in the past, and it's really expanded in the several years that it's been available. But if you're looking for a way to automate collecting rent from your tenants, eRent payments is a platform that you can require your tenants to sign up for, and then it will automatically deduct the rent on the frequency that you want it to be paid automatically. And I think it costs about $3 per transaction, but in most cases, to have that peace of mind that your rent is going to be paid automatically and deposited into your landlord's account, in a hands-off manner, that's worth $3 to the landlord. So if you have tenants, I would think about checking that application out. MileIQ. So this is one that I've recommended for years. This is an app that lives on your phone, and it will track your mileage whenever the app senses that you are moving. So what it does is it tracks, as soon as you get in the car and start moving, it drops a dot and says, okay, this is your starting point. And then once the car stops moving, it drops a dot, that's your ending point. And then it will calculate the mileage in between. And the great thing about this is, yes, it's running all the time in the background, but what I do, and this is a product that I use, once a week, I will go into the app, and then all you have to do is swipe right if it's a business related mileage, or you can swipe left if it's personal related. And why this is so important to keep track of your mileage is one of the misconceptions related to writing off auto expenses for your business is, even though you are using a personal car for business purposes, you need to be able to prove out what is the actual mileage that is business and personal. Most clients come to us and they say, oh, I use it 50-50 for business. And I say, well, that's great, but if you were to be audited, the auditor is going to be looking for a mileage log that justifies and supports that split. So additionally, if you are using a personal car for business purposes, you're going to want that mileage information so you can allocate the business portion to your business tax return. But additionally, if you are using a car that it's in the name of the business, but you're also using it for personal reasons, you need to remember to allocate out the personal portion of that vehicle expense out of your business. So it goes both ways, and that's why everybody needs to keep track of their mileage. There are additional ways to capture auto expenses, and I think I've got another slide. I'll chat about that in a little bit, but highly recommend MileIQ. I think it costs $60 a year to have, but it pays for itself, within the first couple weeks of you using it. And I talked about QuickBooks Self-Employed. If you, utilize this piece of software, you're going to pay $5 to $10 a month, but it's going to help automate a lot of your transactions, a lot of the coding of those transactions, and help you get things like your income statement, your balance sheet, your estimated tax payments automatically, And in addition, a couple of the other great features that the QuickBooks Self-Employed or any QuickBooks product has is it's got the app that you could utilize to not only see your financial information in real time, you don't have to be on a computer, but it also has its own built-in mileage tracker for you. And it also has a receipt capture. So if you're looking for a software or something that will keep the support for every expense transaction that you have, maybe you buy gas and you want to keep that receipt for audit purposes, you can snap a picture of it through the QuickBooks app, upload it, and then attach it to the transaction that is already coded in your software, so that, you know, when you absolutely need it, if you need to prove out a transaction to an auditor or do research for yourself, you could just find the transaction in QuickBooks, and then you can see the attached support to that transaction. Okay, highly recommend that. Okay, section number 3 is I wanted to chat about some of these self-employment considerations that that you should be keeping in the back of your mind. These are things that come up regularly with meetings that I have with clients, and hopefully this will answer some of the questions that you guys have on capturing expenses or business-related issues. So one of the main questions that I get when I'm working with a self-employed individual who has not done this before is, how do I capture things that I use for my business, but I also have it for personal? So that would be things like your cell phone, your internet cost. And that's where you've got to use some estimation. So I'll tell a client, what I would do is you would add up all the expenses that you've paid for your cell phone or your internet throughout the year, and then make a rational estimation of how much you use that cell phone or internet for business purposes versus personal reasons. And then you're going to multiply that percentage by the total cost. And that's how you're going to get your business related expense for your cell phone and your internet. One of the questions that I get asked a lot, excuse me, is, you know, how do I justify that? And you know, if an auditor comes back to me and says, you know, prove out that you actually used it 75% of the time. Yeah, you could go through your call logs and stuff like that, but realistically, I would be documenting my rational thought process for how I'm creating that allocation. So as tax accountants, we're also looking for that for support, because we want to have something documented to prove out why we're using this estimation, this allocation for us. So do yourself a favor and just make a personal note, keep it in your files, document it in your corporate minutes that, you know, in the course of a given week, I use my cell phone for X percentage of my time and internet X percent of my time. Home office deduction is one that a lot of people ask me to explain as well. So the IRS rules allow you to have a deduction if you are self-employed, if you're filling out a Schedule C tax form for working at your home, or if you have, like, you're using your home for storage or something like that. This is different. In 2018, the tax rules changed to eliminate this deduction for employees. So if you are working remotely for your employer and you get a W-2 at the end of the year, this is not applicable to you. That deduction was eliminated in 2018. But if you are filling out a Schedule C and you are self-employed, you can get this home office deduction. And what it represents is, there's two different ways you can figure it. There is $5 per square foot up to 300 square feet of your home can be considered your home office. A lot of people will tell me, Justin, I use my entire living room, you know, for my home office. And I would say, is that reasonable? Is that, you know, justifiable? Or is it a section in your room that you're using for your home office? Yes, if it's an empty bedroom that you're using, like, by all means, capture all the square footage. But if it's if it's an area in your living room, like a desk that's set up in the corner, make a rational estimation of what that square footage is for your home office, as long as it's a dedicated workspace. Alternatively, the other way to calculate the home office deduction is to take all of the total cost of your home. So that would be things like utility costs, repairs and maintenance, depreciation, utilities, adding up that total and then multiplying that total by the square footage percentage that is your home office. So if your home office, your dedicated workspace is 100 square feet and you have 1,000 square foot home, obviously 10% of that total cost is going to be considered your home office. Okay. Mileage, we kind of just talked about that, but the importance of tracking that for business and making that allocation. But some of the areas that clients forget to utilize or forget to track for business purposes are, going to the post office, going to the bank to make a deposit, running errands for your business, going to see clients, picking up supplies. Those are all things that are directly related to your business and should be captured for your mileage write-off. Startup expenses. So these are expenses that you have incurred prior to starting your business. And if you're looking for a time frame, typically we recommend going back in time 1 year from the date that the business opened or made its first sale. So you can capture all of those expenses that you've incurred prior to making your first sale or opening your business. And the way to capture that as a deduction is you can write off the first $5,000 in the first year that you are open. But any expenses beyond that $5,000, you actually need to amortize over a 15-year period. So if this is confusing, if you've got expenses that you need to amortize or capture as startup expenses, or if you have large pieces of equipment or rental properties, this is when I might recommend utilizing the help of a tax accountant to help you factor or calculate those numbers for you. Some of the issues that I see on a regular basis. Number one, not staying on top of your record keeping. So we talked about this in a previous slide. Consistently, business owners get behind on logging their transactions. And I know it can be cumbersome, in some occasions. And, we don't mind this over at Universal Bookkeeper, but a lot of business owners, they dread the entering of their transactions. So if you're not willing to look for somebody to help you do it, you've got to get on that workflow schedule, enter your transactions on a regular basis. Otherwise, like we talked about, at the end of the year, it's just going to be meaningless information that you're giving to your accountant to do your taxes. Doing it on a regular basis on a weekly frequency is going to help you stay on top of it, help you to analyze your financial records over a period of time. Issue number two, not reconciling your bank accounts. So I mentioned that in a previous slide. Not making sure that you've got the same information that is hitting your bank account or your credit card account that is logged into your accounting software. Consistently, we find deviations in this area. One of the things that clients will usually ask is, hey, Justin, I forgot to bring my business credit card, so I paid for this expense with my personal credit card. How do I account for that? And so that's okay on occasion. Don't make it a habit. But if it does happen, what you do is you still want to record the expense in your accounting software, but then you want to reimburse yourself out of the business for that expense that you personally incurred. One other question, going back to support, for these transactions, if I don't have a receipt, how do I justify something that I paid cash for out of pocket personally that I need to run through my business? So if that's the case, I recommend documenting that transaction on a piece of paper. Write down the date that you made the purchase. Maybe you bought a piece of furniture for your office from Craigslist and you paid the guy $100 cash. Write down the date, the person you paid, the amount that you paid, and what you actually bought with that. That piece of paper is going to be your support if you ever were to get audited. So you've documented that you made that transaction. Issue number 3, failing to make estimated tax payments. So this, in case you didn't know, you are actually going to incur a small penalty if you don't make estimated tax payments according to the frequency that I outlined earlier, so quarterly. Additionally, it's not a huge dollar amount, but it's enough that it's like annoying to see on a tax return. If somebody doesn't make any tax payments throughout the year and they think they're just going to pay it all in one lump sum, you could be paying a couple $100 extra, which is nobody wants to pay, you know, a couple $100 extra if they don't need to. Not saving enough for taxes. So like I mentioned before, the net profit of your business is going to be what determines how much tax you're going to pay. Now, the confusing part to most self-employed individuals or most small business owners who are operating as a sole proprietorship is that you have this thing called self-employment tax. So self-employment tax is 15.3% of the net income. So if you make $100,000 of net income, you are going to be paying $15,300 in additional self-employment tax. And what that 15.3 represents, it's the employer and the employee portions of FICA. So your Social Security and your Medicare, 7.65 on either end. When you're self-employed, you are responsible for both ends. If you look at one of your pay stubs, you can see the FICA portion being taken out of your paycheck. That's the employee portion. But maybe you don't see on the business side, the employer also pays that exact same amount of FICA tax for all the wages that you've made. When you're self-employed, you get to pay both. Additionally, on top of that 15.3%, you're going to pay around, I like to tell clients, estimated around 12% in federal income tax. So that pretty much puts a normal taxpayer at less than $75,000 net income, or if you're married, under $150,000. Once you get over $150,000 net income, you're gonna that percentage is gonna go up. But bank on 12% normal federal income tax. Additionally, you're gonna have around 6% of state income tax. So add all those up, you're really looking at just over 30% of tax on the net income of your business. So make sure that you're allocating the amount of tax over to a separate savings account, during the month, so that you have it to make those estimated tax payments and pay the tax due at the end of the year. Most business owners, forget about all of that tax that is going to be due, and they underfund that savings account, and they come up short. Working with a tax accountant might help you along those ways, as we can make a forecast, we can estimate out what your tax liability is going to be at the end of the year. Another issue that I see is not understanding the difference between accrual and cash accounting. So there are two different methods that you can utilize in your business, and you've got to choose one and you've got to stick to it. You can't keep flip-flopping each year, but most clients, I would say, of the clients we work with, at least 80% of them use the cash accounting basis of accounting. And what that means is you're only going to pay tax on the transactions that have hit your bank account, or you've realized the cash for it. So if somebody, if you make a payment via check and that doesn't clear to your vendor for a couple of weeks, that's not going to be something that you're going to include in your income tax preparation, because it actually hasn't cleared the bank. That would be a cash basis of accounting method. On the flip side, the accrual method of accounting would allow you to incur that expense, because the accrual method allows you to record expenses as you have realized them. So realized means, let's just say, if you have completed a project for a client and you have sent them a bill for $10,000, but they haven't paid it, in accounting terms, you have realized or completed that project and you are entitled to that $10,000. So you'd be recording a receivable for $10,000 and you'd be recording income for $10,000. So even though you haven't received that money from the client, you're going to be paying tax on that $10,000. So why this differentiation? So think about a client that has, I've got a client that I'm going to use as an example. They do events. And so they make about $50,000 in 1 year, but the event doesn't happen until the following year. And so do you think it's not appropriate for them to pay tax on the $50,000 that they have to spend to put the event on? So what they are doing is they're following accrual basis accounting, and they're going to be able to defer that revenue that they've already collected, but not realize the service into the following year. So if you're unsure about this, have a conversation with an accountant to talk about what's the best method for you. If you've got some of this timing things to deal with, chances are accrual accounting is where you want to go. But like I said, most clients fall back on the cash basis of accounting. Additional issue number 3, not knowing what forms to file when I am self-employed. So when you are a single member LLC operating as a sole proprietorship or under a DBA, you are going to be filing your taxes on Form Schedule C, which is under your personal tax return. There's no separate business tax return that you are going to be filing. If you are operating in a partnership scenario where there are 2 different people, and this can also be your husband and wife, then you would file a Form 1065, which is a partnership tax return, or if you have a corporation, that would be an 1120 or an 1120S. The business tax returns are going to summarize all of the business activities, and then they're going to give you what's called a K1, similar to like a W-2, that is going to be carried forward to your personal tax return. So just keep that in mind. If you are operating in a multi-person scenario, even if it's your spouse, you're going to want to think about filing a Form 1065 partnership tax return. But if you're operating by yourself, even if you are a single member LLC, you're going to file that tax return on your personal tax return, Schedule C. The last issue that I see a lot is, how do I pay myself when I'm self-employed? So we already talked about keeping the business and the personal accounts separate, and we don't want to commingle them. If you need to pay yourself, let's say you have a net profit of $5,000 and you want to pay yourself that net profit, you're just going to transfer that money from your business account to your personal checking account in a transaction. Don't think about, oh, I'm going to spend the money personally from my business account because that's where it is, that's where I've got my debit card. That is incorrect. My group, Universal Bookkeeper, we try to put out a lot of videos explaining some of these small business items on our YouTube channel. So I would recommend you go and follow us on YouTube. We post on a regular basis, and how to pay myself is one of the topics that we have made a video on that explains the interworkings of it. But if you need to pay yourself as a self-employed or as a business, make sure you're making a transfer to yourself from the business account to your personal account. Okay. And the last thing I've got to talk about is working with your tax accountant. What are the things that a tax accountant is going to need to help you prepare your tax return at the end of the year? So obviously, we need to see your income statement. We need to have that profit and loss to be able to report that information. If you are a partnership or a corporation, you're going to also want to give us a balance sheet, because if you have over $250,000 worth of revenue, you're going to have to report on your balance sheet. You're going to have to submit that to the IRS. Obviously, we talked about mileage being so important to give to your tax accountant, making sure you can allocate that between business and personal. Additionally, a fixed asset listing. So if I'm working with a client that has a lot of equipment or a lot of property, I'm going to be looking for a fixed asset listing so that I can see how much they have actually depreciated or captured as depreciation in prior years, so that I can continue that depreciation or amortization into this current year tax return. So if you don't have, like I said, if you don't have a depreciation schedule or fixed asset schedule, it could be in a return that was previously prepared by another accountant, or think about working with a tax accountant to have them help you put that report together. Super important. Last point is, when you're working with a tax accountant, a lot of clients think that they've got to drop off all of the support for every transaction, every receipt that they've ever incurred, and that is not the case. So as tax accountants, we are not auditing you. We are relying on you to have accurate financial information, and we're relying on you to be truthful that everything that you have reported in your income statement is accurate, is exclusively business related. And so if we're not auditing you, you don't have to give any support for us. So one of the misconceptions that clients or new business owners have when working with an accountant. Okay, so with that concludes my overview of Bookkeeping 101. And now is the opportunity that, I'd like to open it up for the next, 15 or 20 minutes to see what kind of questions are on your mind. Real quick, I'm just going to point out that is my email address and my business website. If you have any questions, you can go to the website, you can schedule a call with us, but I'm happy to answer your questions in the moment to put you on the right track, or I might direct you to another avenue if it's more beneficial. We've got the Mohawk Valley SBDC contact information, as I mentioned on the very first slide. Great resources of information. They're located right in the incubator. I'm sure you guys know all of that. So with that, Zach, I'll turn it back over to you, see if you've got any questions that we can answer for these folks.
Great, thank you, Justin. Thanks for the wonderful presentation. We do have a few questions already queued up, and I would encourage our viewers today to continue to type questions throughout the Q&A period. We do have about 20-25 minutes to discuss. So Justin, the first question that came in has to do with the various apps that you were discussing. And this person asked if you have an app suggestion for tracking receipts.
So tracking receipts. So I've got a couple that I can recommend that I actually use. So I mentioned we've got like a Quickbooks product. So that has a receipt tracker built into it. So that's one area that I would recommend. I have used a program called Expensify in the past, and it's more geared towards receipt tracking for business reimbursements, but that's another one that I've used. One that is doesn't get any spotlight, but I think is extremely useful, is called Shoebox. So Shoebox is a app that, or a program or a service that if you have no desire to keep track of anything, what Shoebox will do is they will send you an envelope each month or whatever the frequency that you desire, and you take all of your receipts and you stuff them in the envelope, and then you send it back to Shoebox. Shoebox will open that envelope and they will scan all of your receipts individually, and then they have software that will read your receipts and pull out the applicable pieces of information and basically do that coding of that transaction for you. Now, it's not 100% foolproof. It absolutely depends on the receipt. But what will happen is after you send those receipts into Shoebox, you'll get a notification that they have coded those transactions for you. You log in and just kind of scan through the transactions that have been coded to make sure that they're accurately reported. And then what you download that information and post it to QuickBooks, if that's something you're interested in. But I have a couple clients that just want total hands off. They don't want to keep track of anything. And so we utilize Shoebox, and they just stuff their receipts in on a monthly basis, send them into Shoebox, and then software takes care of it.
Terrific, thank you. Along the lines of apps that small businesses can utilize, you had discussed the Gusto Payroll app and expressed that you preferred it over QuickBooks Online Payroll. Can you talk a little bit more about why that is? And also, can you talk about how Gusto may integrate with QuickBooks Online?
Perfect, great question. So the reason why I initially migrated over, I used to actually do payroll for a number of clients utilizing QuickBooks Online. But one of the things that you will find when using QuickBooks Payroll is that there's two different tiers of service that you can get. And most people obviously take the more cost-effective one. And if you do that, this QuickBooks Payroll software will not automatically pay those taxes. So one of the things you got to keep in mind when you're running payroll, there are various due dates associated with different filings. And those filings and those payment dates depend on the amount of tax that you've collected for a period. So it doesn't just necessarily mean that you have to file on a quarterly basis and pay the taxes on a quarterly basis. Depending on how much tax that you have collected in a given period dictates when you are supposed to pay those taxes. QuickBooks will track and tell you when to pay those as it has realized or collected the amount of tax for you, but you have to take an additional step to press pay on those taxes and also file on those tax returns. Now, why this is could become problemsome for small business owners is, one, the taxes are not automatically paid when you run the payroll. So realistically, they are an asset to you until they're paid. So the money is sitting in your bank account and you can pay those taxes at the applicable due date. Small businesses run into problems because they don't plan for that additional tax expense that has to come out at a future period. So they've spent the money, and when it comes time to file or pay those taxes, they don't have the money to do that. With the higher level of QuickBooks Payroll, it will help to automate that, but Gusto just does that automatically. So every time you run a payroll in Gusto, it will automatically pay the taxes, take them out of your account, so you don't have to worry about trying to remember when to pay those taxes. Additionally, with the lower level of QuickBooks Payroll, you've got to remember to press the button to file the quarterly tax returns. Now, small business owners are really not doing this on a regular basis, and they may forget to push pay. Well, if you don't press pay, based on the time frame that QuickBooks Online gives you, file, then your filings are going to be late and you're going to get a penalty. And that penalty can be like 10% of the taxes that are due. And it's a huge waste of money. Gusto will automatically just file those tax returns automatically for you without you having to think about it, which I like. One of the other features why I utilize Gusto rather than QuickBooks Online is they have a really seamless onboarding function. So a lot of clients don't know all the forms that need to be filled out by an employee. And so when I am hiring somebody through Gusto, all I really need to do is enter their name, their pay rate, and their email address. And then Gusto will send them an onboarding application that the employee can fill out, their demographic information, their W-4 for tax withholdings. They can fill out their direct deposit automatically, and the business owner doesn't have to worry about, following up with the employee to get that information or figure out where to enter it into the software. Gusto will automatically do that for you. So additionally, Gusto will integrate directly with QuickBooks Online. There's a very seamless syncing tool, and it just runs automatically in the background. So every time we run payroll for a client, that payroll information is coded perfectly into QuickBooks Online and hands off. So those are some of the reasons why I like Gusto, and their customer service is like beyond the best. I swear, whenever you call them, they're legitimately smiling on the other end. And so that's something I really value in the company.
Great, thank you. We have a question here about securing data. And this person asked if you could just comment on cybersecurity and what measures they may need to take to secure their data, whether that may be built into a service like QuickBooks Online, and what steps they could take if they were perhaps keeping books via a different method, like a spreadsheet on their computer.
Yep, so obviously every platform is a little bit different. QuickBooks Online has its own backup tool. They've got their own cybersecurity. There's an audit form I believe it's called SAS 70. I used to be an auditor, that has an outside entity audit the cybersecurity of certain online platforms. So if you're ever concerned about like the secureness of a online site, consider asking the software for a SAS 70 report, which is like an audit of their cybersecurity. So QuickBooks Online is, a nationally based software. Obviously, they've got a lot of redundancies and backup, and they've got a whole security site that you can actually read on what they're doing behind the scenes. If you're using another piece of software or keeping your information in an online platform, I would recommend creating two different ways that that's backed up. So maybe it's backed up through the online site that you're using, but I would consider on a regular basis, like a monthly basis, downloading and keeping that information on your hard drive or an external drive for support. With QuickBooks Online, if you're ever even worried about having a backup for that, they've got a very seamless tool within QuickBooks that you can export all of the transactions, all of your customer lists, all your vendor lists into an Excel file, and it only takes a minute or two, and you can download that periodically. I do that for a lot of clients, just in case, and so we can keep redundant backups for those QuickBooks products electronically. So if ever something were to happen, you can actually recreate the file from scratch. But I would consider looking at the redundancy objectives on each platform, but keeping two separate copies is always advisable.
Great, thank you. Question here, do you have any specific tips or things to consider for nonprofits? In regards to, so just in terms of sort of a high level overview, are there any of the things you discussed today, would they differ at all for a nonprofit?
Yeah, I mean, nonprofit tax returns are a little bit more robust. Let's call it a 990. You definitely have to keep track of different pieces of information. So one of the things that jumps out to me are grants that are restricted temporary grants that are only supposed to be spent in a specific manner. So this is something that's really near and dear to nonprofits' hearts. They get a grant from some organization and they can only spend it in a certain way. So I would highly advise making sure that you're keeping track of those individual grants or restricted funds within your accounting software. I know in QuickBooks we do this a lot. For clients that get a grant, we can create a class code, we can create a customer that will track those expenses and the income that's associated with that particular restricted money, so that you can prove out at the end of the period how you utilized those funds. Obviously, the person asking may or may not know that you've got to also report on donors that have given you money over a certain threshold. That threshold is $5,000. So you need to be mindful of the donations that are coming in and keep track of donations above and beyond that dollar amount, because that needs to be reported on the 990 as additional pieces of information. 990 is pretty robust, that it asks for a lot of policies, and so one of the things, not really accounting related, but making sure that you've got all of your policies, data destruction policy, you've got a compensation policy, that's all going to be listed in that 990, and those are things that I would want to keep in mind if I was a nonprofit. But for the most part, besides the tax ramifications that are associated with operating a nonprofit, business-wise, you're going to be doing a lot of the same functions. So we service a number of nonprofits, and like I said, for the most part, beyond the things that I just mentioned, the temporary restricted funds, the donors, operationally, it's going to be roughly exactly the same.
Okay, thank you. Question here, and we don't want to get too specific or go too far down the rabbit hole of this specific question, but perhaps this is something that you could again address sort of at a high level. This question says, what if our business pays for a lot of supplies up front before completing a job and being paid for it? Upon reviewing last year's P&L, it showed a very large loss, but as someone benefiting from the profit, it isn't really an accurate idea of our finances. Is there a better way to look at those reports than just looking at net income?
Yep, yeah, so that kind of falls back on what we were talking about with the cash versus accrual basis of accounting. So in this example, it sounds like you purchased all of the supplies for a project, let's just say in December, and you incurred that expense. You paid cash for it, you see it coming out of your bank account, but you didn't realize any revenue. So in the prior year, you're showing a big net loss. Well, now in the following year, you don't have any expense to post against the large profit that you probably obtained from that project. And so you're going to pay less tax in the prior year or no tax at all because you're showing a net loss, but you're going to show a giant profit in the following year. I would consider thinking about changing to the accrual basis of accounting if that's something that's going to be consistently happening. Because if you did do that, if you were accrual basis taxpayer, what you would do is, even though you incurred that expense and you paid that money out, you would actually be able to defer that expense to the time that the project is completed. And that way you would be more able to match up the revenue and the expense in the same period. So think about talking to your tax accountant. You can file an application with the IRS to change your method of accounting, but they don't want you to be filing it every year. So if you're going to make a change once, but it can be done.
Great, thank you. And so just to follow up on that, you had mentioned that you would recommend a business decide on a method, cash versus accrual, from the start and stick with it if at all possible. Yep. You discussed the fact that this business may want to consult with a tax professional to make that decision. When do they need to make that decision? Is it on day one? Is it when they file their first year's taxes?
Yeah, so technically it's when they file their first year taxes. So if you haven't filed a tax return for your business yet, and you get to the end of the year and you're having all these questions in your mind, technically speaking, you can make adjustments to your financial records and identify that method of accounting on the first year tax return. But if you filed, like I said, most tax preparers, if they don't get any information that the client has told them specifically that they're accrual basis taxpayers, they may automatically default you into cash basis. And then you're kind of like locked in until you make this application with the IRS to change that method of accounting. So if you're doing your first year you return, in particular with an accountant, make sure to ask that question. What do you think the best method of accounting is going to be for my business, cash or accrual? If you've got things that are covering different years, then chances are accrual is going to be better for you. But if it doesn't really matter, and you just want to spend the money just to realize the expense, then cash is going to be the right way for you.
Thank you.
Yep.
This question is something that we get asked quite a bit as business advisors. You discussed startup expenses and the fact that a person, should track business expenses for up to a year prior to actually forming the business. In conjunction with that, you also talked about how the business's share of personal expenses, such as a cell phone or internet, or a home office expense or mileage, could potentially be deductible. Are those businesses' shares of personal expenses also deductible during that startup period?
Yeah, so it definitely depends on the expense, but chances are they would be included in that. So you would want to capture all the things that went into, starting that business. And what you're going to be doing is, like I said, you're going to be compiling all of that information and deciding if it's going to be an expense in the current year or if you're going to have to amortize it over 15 years. So I would recommend keeping track of everything that you can directly relate to the business, and go back a year as a starting point. Obviously, if you purchased a big piece of equipment, a year and a half or 2 years prior, and you know that you're going to use it, but things have delayed you to actually starting that business, I would still include that as a business-related expense for amortization purposes. But rule of thumb would be like a year prior to the opening or first revenues received. But yes, keep track of everything, and then decide if it's going to be something that you amortize or expense in the current year.
Great, thank you. A couple more questions to get to. We have about 5 minutes left. This is another one that gets asked to us quite a bit, and it has to do with separate bank account. For a sole proprietor, can you just paint a little bit clearer of a picture of exactly what it would look like to maintain that separate account? If that person would like to purchase something for their business and they don't have the money in their business account, how do they complete that transaction? And then again, explain a little bit how they would pay themselves.
Yep. Okay. So a couple things in there. When you're first starting out and you need to open a bank account for your business, one of the things that the banks are going to look for is if you have a separate entity already set up. So that would be like a corporation or an LLC. If you do have one of those things set up, chances are you've got your own separate tax ID for that entity, and then you can set up a separate business account using that information. If you are operating under a DBA, but doing business as, you don't have a separate LLC, you can still obtain a bank account with a bank under that DBA name, and thereby utilizing and create that separation of business and personal related accounts. So that's where I would start. And then if you don't have a DBA, then just open a separate share or a separate checking account through your current personal accounts to utilize exclusively for business funds until you make the next step in terms of forming a DBA or an LLC. So it can still, fall under your personal account, but by doing that, that's how you're going to pay yourself or reimburse yourself for any expenses. So if you need to pay yourself $1,000 because you did really well last month, you're going to be making that transfer, and that transfer is going to be the transaction that shows how you're getting paid. Now, that transfer is not going to be considered an expense of the business, which is actually one of the most confusing parts. Is paying myself is not a business expense. It's really what's considered an equity transaction, a distribution of capital. But to not get into the debits and credits, be sure to not code that transaction of paying yourself for your net income as an expense. However, if you are reimbursing yourself for gasoline or office supplies that you paid for, then that would be a business related expense that you would code for tax and accounting purposes.
Terrific, thank you. I think we have time for just one more here. We've had a couple questions come in asking about setting up a consultation with you. How would somebody go about doing that, and what would the cost be?
So usually the best way to set up a time to chat with me would be to go to my website, universalbookkeeper.com, and if you go to the Contact Us page, there is a form that you can fill out with your name, email address, and what your overall question would be. And then from there, somebody from our team will reach out to you to schedule a time that works for you so that we can connect. Typically, what we call a client discovery call is not something that we charge any money for. We want to get to know you, want to get to know what some of the issues or problems that you have. But if it's something that we are going to actually do some legwork for you, maybe you were filing a sales tax return or something, anything actionable that comes out of that meeting would be something that we would bill for. We would talk about that before it happens.
Terrific. Thanks a lot, Justin. We're getting ready to wrap up here. Is there anything else you'd like to add before we conclude for the day?
No, I just want to say thank you to the SBDC for putting this on. I'm very happy to do this. I think it's a really great topic that, small business owners have a lot of questions on, and I'm happy to be here as a resource.
Terrific. Well, I'd like to thank you again and thank everybody for joining us today. Just a couple brief things before we wrap up. If anyone would like to make an appointment with an SBDC business advisor, if they're located outside of the Mohawk Valley region, they can go to nyssbdc.org and click on Make an Appointment. If you're located in the Mohawk Valley and you'd like to make an appointment with one of our business advisors directly, you can fill out our intake form at the website thinkubator.co/intake. That's thinkubator.co/intake. You may also call our office directly at 315-731-5884. We'll be sending out a follow-up email with a recording of this presentation later in the week. And after you exit the webinar, you'll see a brief survey pop up. We'd appreciate if you would take a moment to fill it out. Thanks again, everyone, and have a good afternoon.
Thank you, Zach.